Welcome back, everybody, and good morning. I hope you are enjoying your day so far. I recently came across an article that was interesting because it's talking about qualified custody for clients and how the SEC is going to be probing Wall Street over whether or not they have been offering crypto custody to their clients and if they're qualified to do so. This article was released a few days ago. It was on Cointelegraph. And we're going to go through it really quickly here. U.S. securities regulator probes Wall Street over crypto custody, report says. According to sources, the regulator has been probing registered investment advisors over how they offer crypto custody to their clients, which I think is exactly how are they offering custody, because if anybody else is holding your cryptocurrency, well, the old saying goes, not your keys, not your crypto. And the last thing you want is somebody else holding your private keys, no matter who they are. I think we've all seen enough of just how much you cannot trust any kind of centralized entity. But let's go through this and find out what this says. The United States Securities and Exchange Commission, the SEC, has been probing traditional Wall Street investment advisors over what they may offer digital asset custody to its clients without proper qualifications. And so the only custody that you ever want is self-custody. You want to be responsible for your own keys, and you want to be in control of your own wallet, and you generally want to keep your cryptocurrency off any kind of exchange. You can use a hardware wallet or you can use a paper wallet. It really just depends on what you prefer. But yeah, you definitely do not want to be keeping it on exchanges. You also don't want to be keeping it on like a MetaMask wallet either. You generally want to keep it off-chain, well, on-chain, but offline. In like cold storage is kind of the term that they use. As in January 26, Reuters reported, citing three sources with knowledge of the inquiry, said the SEC's investigation has been going on for several months but accelerated after the collapse of the crypto exchange FTX. The investigators by the SEC had not been known before, as the agency's inquiries are not public. So now they're coming out and kind of talking about what they've been doing, probably because there's been a lot of ire on the cryptocurrency community since the collapse of FTX, and before that things like Celsius, which put a lot of stress on the market in general. And as well, it probably really kicked the regulators into gear to try to get a hold on things before they got too much out of hand. As per the Reuters report, much of the SEC's efforts in this inquiry are looking into whether registered investment advisors have met the rules and regulations around the custody of crypto assets for their clients. And I, again, don't really understand what the best form of custody is other than self-custody when it comes to cryptocurrency. I really do think that they want you to believe that the only type of custody that should be trusted is some kind of custody that is similar to a bank or outside of your control, where you're trusting some entity, some company to hold your cryptocurrency. You could, I guess, make the argument that perhaps it's insured, but at the same time, are you going to have free access to it whenever you want? You can make the same argument about banks. Well, my money's in the bank, it's insured. Well, go right now and try to take out all your money. You're going to find, if you have a bit of money too, you're going to find out that that is not the case. If I went and tried to take out $50,000 from my bank account right now, which I've tried to do before, I have to order a money order, and I'm waiting several days to get my money because the bank cannot satisfy depositors. This is because they are lending out your money. And I imagine the same thing will happen with cryptocurrency assets. Once there is enough of it within these qualified custody holders. Goes on to say that by law, investment advisory firms must be qualified to offer custody services to their clients and comply with custodial safeguards set out in the Investment Advisories Act of 1940. That's probably going to need to be updated. Cointelegraph reached out to the SEC to clarify on the matter, but they did not receive an immediate response. Some action on Twitter here. Gary Gensler goes on to say that if adopted, our best X rule, don't know exactly what that means, would help ensure that brokers have policies and procedures in place to uphold one of their most important obligations, to seek best executions when trading securities, whether equities, fixed income, options, crypto security tokens, or other securities. So interesting. So not only will they have custody of your assets, but you would be seeking them to actually execute your trades. That's kind of interesting. Let's see what he has to say about this.
In December, the Commission proposed a new standard of best execution, best X for short. What does that mean?
Best execution.
Best X might sound like you're best friends with your ex. It's actually a central obligation for brokers, simply to seek best execution when their customers, are trading securities like equities, fixed income, options,
crypto
or
security
even
tokens. Notice how they're always doing that
best
lately.
execution
Any
has
article
been an
that you read
obligation
lately.
for decades. When I started at the SEC, I was surprised to learn we didn't have our own best X rule outside of a self-regulatory organization role. I think a best execution standard is far too important, too central to protect investors.
It's all about your protection.
And the
It's always
SEC's
about your
mandate
protection.
not
So
to
we need
have
control
it
your
on the
money.
books of the Commission as well. Our proposal makes important enhancements regarding brokers' core duty to everyday investors. Say you use a broker through a brokerage app that receives payment for order flow from an off-exchange wholesaler operating in the dark market. That presents a conflict of interest. This raises a question about how brokers
It's not a dark
handle
market.
their best execution obligation in light of those conflicts that may lead them to place their own interest ahead of your interest. Well, how would this proposed regulation best X address such conflicts? Under the proposal, so-called introducing brokers, those are the ones who take your orders and send it off to executing brokers.
Very interesting.
Often those off-exchange wholesalers in the dark markets. Well,
I love how they
the
keep calling it
introducing
dark
broker
market.
would have certain additional best executional requirements. Look, that broker is who you hired, and they would remain on the hook rather than kind of outsourcing the best execution obligation to the executing broker in the dark market. Further, your broker would have to review the execution quality it actually gets from the wholesaler. Kind of makes sense. In particular, your broker would have to compare that execution quality with what it might obtain from other markets.
From the markets.
Your broker couldn't just assume that the wholesaler paying for that order flow is providing the best execution quality. On top of this, the proposal specifies in some detail the policies and procedures that all brokers would need to have when it comes to best execution. The proposal is designed for you, the investing public, to get
for your
best
protection,
execution. So please
the
weigh
dark
in.
market.
We benefit greatly from your feedback. We're accepting comments through the end of March. Best X might just turn out to be investors' new bestie.
So that's very interesting. Yeah, the idea of the dark market. You know, when you think about it like this, go to DeFi Llama, go to Dapps Radar, have a look at the so-called dark market when it comes to cryptocurrency. These applications are part of what's known as decentralized finance. Lending, DEXs, which are decentralized exchanges, staking. There is no dark market when it comes to this stuff. You can just go to the chains. You can look on Etherscan. There are different other types of scans for different chains. You can see all the transactions that are happening to associated wallets, your wallet, other wallets. You can see where all your money is going. There is no dark market. And same thing when it goes for all decentralized finance across all chains. You can use Dapps Radar as well to look at these kinds of things. You know, they break it down into the different sections that make up what is known as DeFi. And when you look at what these people are saying about how you want to be dealing with these qualified custody people, the only thing that in their minds that really makes them qualified is them making sure that you're not holding your crypto on your own wallet. They want to do that for you. The last thing that they want, these banking elites, any of the people in centralized finance want you to do, is catch your money out of that system. They want that money in that system, and they're doing everything that they can to control and regulate the decentralized financial space right now. And they're doing it under the guise that, if you watch the video there was a lot of, this is for your protection, we're going to execute the best trade for you, we're your new bestie. I think a lot of that kind of stuff is just the same thing as like propaganda. They're trying to build a narrative, get you a little bit more afraid of going out on your own. You can just trust us, don't worry. Coming back to what I said about how banks work, it's very similar. Banks want you to think that your money is the safest it is with them. They don't want you taking your money out of the bank. And they do actually make it quite hard for you to take it out of the bank. As I was saying, if you wanted to go take out, 5 figures right now, it's going to be difficult. You're going to have a hard time with that. If you don't believe me, go to the bank and do it. The rest of the article, the recent revelations suggest the SEC hasn't turned a blind eye to traditional investment firms in the digital asset space. Anthony Sakine, and I'm butchering that, who leads Seward and Kissel's blockchain and cryptocurrency group in a note to Reuters, quote, "This is an obvious compliance issue for investment advisors. If you have custody of clients' assets that are securities, then you need to custody those with one of these qualified custodians." And so now it's like it seems to be 2 degrees of separation there. So if you're dealing with a broker, that broker needs to then deal with a qualified custodian for your assets. And again, they're using terms like securities. Cryptocurrency tokens are not securities, but they are doing everything that they can to try to define them as securities. Just they're kind of moving the goalposts, so to speak, to change the definitions around what can qualify as a security so that they can try to envelop the digital asset space into this so that they can control it and write legislation around controlling it, and ultimately in the future punish those people, yourselves as cryptocurrency holders and anybody that might be dealing with those cryptocurrency holders as well. And so it's going to be harder and harder for people to get access to the digital asset space if they continue to try to classify cryptocurrency tokens as securities. And they want to do that. That's the last kind of step before they really rope in the decentralized asset space, and as they walk us towards the inevitable CBDCs and the digital ID, which is definitely kind of going hand in hand with their legislation right now that's coming out around cryptocurrency tokens. If you follow what's been happening in the government lately, it kind of is pointing that way. They are, I think, trying to walk up both sides of the aisle right now, and they're trying to kind of appeal to both sides. A lot of people within the cryptocurrency space, they get kind of blindsided, and they, more or less they just kind of have the blinders on when it comes to how certain politicians will talk about cryptocurrency in a positive way. Ted Cruz, for instance, saying that he wants to bring crypto payments to the Capitol. I feel like he's appealing to both sides, really, of all this. I mean, he's definitely for CBDCs. Most people in our governments are for CBDCs. They're working very closely with these entities to make sure that the policies and legislation gets passed so that it is ending up in the countries that you're in. And then as well, too, they have to kind of also appeal to the other side of the aisle, because they know that there's quite a few people in the digital finance space, the decentralized finance space, that want nothing to do with that. But they have to make us feel like we're all part of the same group. So you're going to see kind of a lot of that happening with certain politicians as we kind of get closer and closer to what's inevitably going to be a CBDC. But again, I would encourage people to use the decentralized finance space. Again, you can use websites like DeFi Llama or dApps Radar to do kind of the initial research on the different decentralized applications that do exist across all these blockchains. Many of them have thousands of users, billions of dollars in locked-in value, and have been around and kind of stood the test of time. Similar to how Bitcoin's ledger has so much trust, a lot of these decentralized applications also hold similar amounts of trust. They've been around for quite some time. And you can get a yield on your assets that's completely removed from the banking system, totally controlled by you. If getting in and out of the markets in a decentralized way is an issue for you, I would suggest using things like localbitcoins.com that puts you in contact with other people in a peer-to-peer kind of decentralized fashion, where you can meet up with them and you can buy cryptocurrency. That's kind of exactly how I bought my first Bitcoin. And this keeps you kind of as far away from the centralized space as you can. And if you do buy any of these tokens, Optimism, Polygon, the Arbitrum token, off of an exchange, I would suggest getting it off the exchange as quick as possible. Obviously, because of security concerns, look what's happening with the centralized finance world when it comes to cryptocurrency. It's all full of fraud. Celsius, you have FTX, these things destroyed billions of dollars worth of assets. And as well too, you're going to be able to get a much better yield, a much higher yield, and you're going to be in total control of your assets, self-custody being the goal. But more or less, that's kind of my thoughts on that. I'm really hoping that more and more people, shift away from anything centralized and go towards the decentralized space. Bitcoin doing really well still, kind of holding our 1 month gain here, and hopefully we do break out. But that's all I got for you guys right now on this. We'll keep an eye on this story as it develops. Let me know your own thoughts, if you've got anything to say about your own experiences when it comes to the centralized finance space versus the decentralized finance space. If you think one is better than the other, I'd like to hear about it. If you enjoyed this video, consider leaving it a like, and you can share it as well. And if you want to see more content like this, you can consider subscribing. Until next time, I'll see you guys.